$180 billion. That's how much American banks extracted from minimum payment traps last year alone. And here's what makes this absolutely insane. They're doing it with your money, using a system so brilliantly designed that 67% of cardholders don't even realize they're caught in. I'm going to show you exactly how this financial extraction machine works, and by the end of this video, you'll understand why making minimum payments might be the single most expensive financial decision you'll ever make. But first, you need to know about a document that changed everything. A leaked internal memo from 2019 that banking executives never wanted you to see. It called minimum payment customers revolvers and labeled them as the most profitable segment in consumer banking history. Now, before we go further, quick note, this is educational content, not financial advice. Always consult professionals for your specific situation. But what I'm about to reveal, this is backed by Federal Reserve data, internal banking documents, and the math that credit card companies desperately hope you never do yourself. Let me paint you a picture. Sarah, composite of thousands of real cases, graduates college in 2020. She has $8,000 in credit card debt at 22.99% APR. The minimum payment? Just $240 a month. Seems manageable, right? The bank censors statements that make it look simple, clean, easy. They even congratulate her for staying current. What they don't show in large print, if Sarah makes only minimum payments, she'll spend the next 31 years paying off that $8,000. And the total cost? $23,456. That's right, nearly triple the original amount for debts she could have paid off in 3 years if she'd known the real math. Now, multiply Sarah's story by 175 million Americans carrying credit card balances. The average debt? $6,501 per person, and 53% of them, more than half, make only minimum or near minimum payments. This isn't an accident. This is architectural. The minimum payment formula was engineered in the 1970s and perfected over 5 decades to accomplish one singular goal: maximize the total interest extracted while keeping you comfortable enough to never pay off the balance. Think about that. The system isn't designed to help you pay off debt. It's designed to keep you in it. And it's working. Oh, is it working? Let's talk about what everyone thinks is happening versus what's actually happening. Most people believe minimum payments are a courtesy, a helpful option for tough months, the bank being flexible and understanding. That's the story. Here's the reality. Minimum payments are a product. A product. One of the most profitable financial products ever created. Banks market them as responsible debt management when they're actually the opposite. They're debt multiplication devices. The Federal Reserve released data in 2023 showing that customers who make minimum-only payments generate 4.7 times more revenue for banks than customers who pay in full. But here's where it gets sinister. Banks have optimized every aspect of this system through massive data science operations. They know exactly which customers will get trapped, how long they'll stay trapped, and how much profit each trapped customer will generate over their lifetime. They call this customer lifetime value modeling. I call it something else. And the most disturbing part, the minimum payment formula itself, the actual math that determines how much you're required to pay each month, that formula is deliberately designed to keep you in debt as long as legally possible while avoiding regulatory scrutiny. There are people inside these banks, brilliant people with PhDs in behavioral economics and data science, whose entire job is optimizing this extraction. But here's what the experts and insiders won't tell you. The formula has a hidden component that most cardholders have never even heard of. See, most people think the minimum payment is just some percentage of your balance, maybe 2% or 3%, and technically that's partly true. But there's a floor, a minimum payment, if you will, usually $25 or $35, and this creates what bankers internally call the compression zone. Here's how it works. When your balance is high, let's say $10,000, your minimum payment might be $300. That's 3% of the balance. A decent chunk is going toward principal after interest. But as your balance drops below certain thresholds, $3,000, $2,000, $1,500, the payment gets compressed to that $25 or $35 floor. And at those lower balances, nearly 100% of your payment is pure interest. You're barely touching the principal. The debt becomes almost immortal. This is why you'll hear stories of people saying, "I've been paying my credit card for 5 years and the balance never goes down." That's not bad luck. That's the compression zone working exactly as designed. Let me give you a real scenario. Mark, based on a case I analyzed, had $2,400 on a card at 25.99% APR. His minimum payment was locked at $35. Here's what happens each month. His monthly interest charge, $49.98. His minimum payment, $35. Wait, his interest is higher than his payment? Yes, which means every month he makes that minimum payment, his balance actually grows by $14.98. Mark isn't treading water, he's sinking while being told he's swimming. And it's completely legal, because technically he's still paying the minimum required payment. The bank will never call him, never warn him. They'll just keep sending statements congratulating him for being a valued customer in good standing. Meanwhile, his debt grows, and his interest payments flow directly into bank revenue, which flows into executive bonuses, which flows into shareholder dividends. And this isn't some rogue operation by one bad bank. This is industry standard. Standard. Chase, Bank of America, Citi, Capital One, Discover, the top 5 card issuers control 71% of the market, and they all use virtually identical minimum payment formulas. Why? Because they all hired from the same consulting firms in the 1980s and 1990s when credit cards transitioned from charge cards to revolving credit. The formula wasn't developed to help consumers manage debt. It was developed to maximize what they called net present value of the customer relationship. Translation: how much money can we extract from this person over their lifetime without them defaulting or closing the account? And they nailed it. They absolutely nailed it. The current minimum payment formula represents the perfect balance point, high enough that regulators don't crack down, low enough that customers never escape. Okay, let's get into the actual mechanics of this system, because once you understand how the minimum payment formula works, you'll see the trap that's been set. First, and this is crucial, there is no federal law requiring a specific minimum payment formula. None. The formula each bank uses is entirely at their discretion, as long as it meets some very basic regulatory guidelines. Those guidelines? The payment must cover at least the interest accrued that month plus fees, and ideally make some progress on principal. That's it. That's the entire federal requirement. So what do banks actually do? The most common formula looks like this. Your minimum payment equals the greater of 1 to 3% of your statement balance plus all interest and fees, or a fixed floor amount, usually $25 to $35. Let me break that down with real numbers. Imagine you have a $5,000 balance at 24.99% APR. First, calculate monthly interest. Annual rate, 24.99%, divide by 12 months, 2.08% monthly rate. Apply to balance, $5,000 times 2.08% equals $104.17 in interest for that month. Now the minimum payment formula. Most banks use 1% of balance. $5,000 times 1% equals $50. Add the full interest. $50 plus $104.17 equals $154.17. Compare to floor of $35, $154.17 is higher, so that's your minimum payment. So you pay $154.17. Seems reasonable, right? But here's what actually happens to that payment. $104.17 goes to interest. That's 67.5% of your payment. $50 goes to principal. That's 32.5% of your payment. Your $5,000 balance drops to $4,950. You made a payment and saw progress. Feels good. Next month, same calculation with new balance. $4,950 balance, slightly less interest, slightly smaller minimum payment. And here's the insidious part. The minimum payment decreases every month as your balance drops. Why does this matter? Because human psychology says, hey, my required payment went down from $152 to $151. That's good news, right? Wrong. Wrong. It means the bank is deliberately slowing your payoff. They're reducing your payment to stretch the debt across more months, generating more interest. If they wanted you to pay off the debt efficiently, the minimum payment would stay constant or increase, but it doesn't. It decreases on a perfect curve calculated to maximize their revenue. Now, let me show you what happens on the long term with this $5,000 example. If you make only minimum payments on that $5,000 at 24.9